Yeah, I saw you're asking a VC channel, but actually, we're live.
Okay.
We're live. Hi, Ryan. Welcome to Venture with Grace today.
Hey, Grace. Nice to see you. Good to meet you.
Okay, so to start the show, I would love for the audience to get to know you a little bit more. So you started your career in venture over like 30, I would say like almost 30 years ago. It's like 29 years ago.
Well, it depends.
Yeah,
Well,
keep going.
it depends what you consider venture. I
Mhm.
started Storm with a
20,
couple of other partners back in 2000, so 24 years ago.
I
But I started my career at a private equity firm right out of college called Summit Partners. Basically, as what people might think of as like a BDR today in SaaS software, where I was calling a lot of founders and trying to convince them that Summit would be a good partner. And so I started in private equity some time ago, but really venture started in 2000.
I wanted to learn more about okay, so over your 23 years of experience, you have like multiple funds now. Like I wonder, like I was listening to you on your on this other podcast about um, the like one of your fund closed like by the time that you were you were like doing the podcast, and then finally, I wonder what does a 10-year management period kind of look like for a fund?
Well, you've probably heard other people talking about this. It's a bit of a historical artifact, to be honest, that it's a 10-year fund life. It's such an artifact that today most funds, when we bring new LPs into a new fund and we all agree on a new agreement, there's actually automatic extensions to that 10-year, because I think everyone really understands that 10 years is a little unreasonable in terms of that hold period, often for a single company, but let alone for an entire portfolio. I think the way we think about it, we're very actively investing a fund over generally the first 3 years or so of that fund's life in terms of new investment opportunities, right? We're trying to find net new companies to invest in. Over maybe the next 2-3 years, there's quite a bit of follow-on capital that needs to go into the best companies in the portfolio. Okay, so the B rounds, the C rounds, if everything works out great, they often then are going to raise more money to be able to invest in sales and marketing. But then at some point, you really want to be thinking about liquidity. How are you going to manage the portfolio? But the reality is, I think today there's just a lot of companies that we have in the portfolio that are excellent businesses, that have strong balance sheets, that are growing quickly, that may not yet be the scale to be a public company, because that bar now is pretty high in terms of, getting public. And they're great businesses that have high growth rates that also maybe aren't a great fit for a private equity firm. And so, we need to continue to manage those. And I think the good news for most of them is, look, they're growing businesses, they're compounding in growth. And so, ultimately it will all work out, but it does mean a longer hold period.
I wonder, so for throughout your 20 years building a fund, I wonder, does the LP database change each fund, or do people stay from fund 1 to call it fund 10?
It definitely changes fund to fund. Investors will change their strategy and their allocations, or someone will get a new mandate, or they'll have a new CIO. And so all of that changes, and we have some change in the LP base. But at the same time, we have a lot of investors that have been with us for the entire length of Storm. And, we've been able to generate great returns for them. And, and as a result, I think they're happy to continue with us as a venture manager.
Totally. I saw that. So you invest in data infrastructure, engineering, HR, workforce, and just a bunch of sectors in the SaaS space. What's the general overview throughout your fund building career over 20 years? Since I feel nowadays people are really passionate about AI, but I feel you're not chasing the major trends right now, or maybe you are, but I would love for you to like share a little bit more of your take on like these like mega trends that shifts towards the SaaS space in general. Nowadays, like everyone's a SaaS investor. What's your kind of like view on the SaaS space right now, especially in, like when AI is like very dominating the market?
So maybe I'll just take a quick step back and just say, in terms of what we focus on as a fund, and then that'll give good context for what we're doing today. So as a fund, you're right. All we do is B2B SaaS, and we're somewhat opportunistic within B2B SaaS. As long as there's a business buyer on the other side, we're willing to look at a lot of different market segments. And, I've always had the belief that the founders and entrepreneurs that walk in our door are going to have the best ideas and the best perspectives. And so we try to stay very open-minded as long as it's a B2B buyer on the other side. And the reason that's so important is for us, we realized years ago that it didn't really matter whether you're selling CRM or security or dev tools, as long as the buyer is a business buyer, a lot of the go-to-market playbooks are very much the same. And in early stage venture, one of the fastest ways to incinerate capital is being inefficient in terms of how you build out that go-to-market channel. And that really defines greatness. It's hard to get to $1 million of ARR, but it's really hard to get to 50. And so that part of the journey, because it's something that regardless of what these companies are building, as long as it's selling to a B2B buyer, is consistent, that's something, we think we can really lean into and, do a lot more for our companies than say trying to help them with a particular product specification or something. So that's where we focus, and that's our North Star. That's what guides our entire investment strategy. That's how we think about what we're going to invest in, how we're going to work with our companies, and so forth. So within that context, I mean, AI to us is without question one of the biggest technology trends of my entire career. So is it important to us? Of course it is. I mean, there isn't a company that comes through our door today, or virtually no companies that doesn't have AI as part of their pitch. Okay. So what it reminds me of a lot is it's like, the internet. I mean, it's fundamental. And so it is a component of the broader investing strategy, but it's not something that we're just investing in AI because AI is everything. So it doesn't make as much sense to me to say, hey, we're just going to be an AI investor, because I don't really know what that means, because AI touches everything. The one thing maybe, I think that's relevant, especially today, we don't do a lot of AI infrastructure investing. Okay. So we're not an OpenAI, we're not Anthropic, we're not Perplexity. We're not investing with all the cool kids in those companies, really for two reasons. The first is we have a relatively small fund. It's 220 million. We've always kept our fund sizes small. We can talk about that if you want to, but as a result, if a company is burning, 10 billion a year, it's not a good focus for our fund, because, that's just, it's not a good match. It's a better match for either a strategic investor like Microsoft or an Andreessen Horowitz, or, somebody that wants to deploy a tremendous amount of capital. So we're not doing a lot on the infrastructure side, which is honestly where a lot of the, action is today in terms of very specific AI businesses. But yeah, don't be confused about it. I mean, like virtually everything we're doing at Storm today in terms of new investments has an AI component to it.
I wonder, so I totally agree with you. I feel like this is like equivalent to like the internet transformation, which is like every company is on the internet right now. I wonder, like, for the niche here sector. So like, I know that like you invest in like multiple different spaces. So I'm just going to give you like a random example. So for example, if there's like a fintech B2B SaaS company and they are how do you for example, they're selling to a high-end clientele, call it like hedge fund or like some sort of like bigger like or endowments or like some bigger funds. I wonder, like, for a niche subject, like how do you quickly evaluate if they could get to like $100 million ARR? Because from the founder's perspective, I feel like everything is so they would think everything's possible, but like I wonder, how do you quickly evaluate them to like put in like, call it like $1 million to $5 million check into a company?
Well, I wouldn't say, there's a lot of investors that you'll hear, they have one meeting and they know they're going to invest and they just write the check and they say, why can't everybody else do that? I'd say for us at Storm, we take a little bit more of an analytical approach to things. And I think we get excited all the time about first meetings and think a company has potential. But, oftentimes then we do some work and we think more about it. And maybe it's a market we weren't as familiar with, and a lot of times we come to a conclusion that we're not as confident that the market size is there. It's one of the hardest things, I think, in terms of us evaluating investments is that market size question, because oftentimes in these new kind of SaaS segments or vertical, like which is what you referenced, companies don't really exist there today. And so it can be hard to understand how big is the opportunity. I mean, if I said CRM, everyone's like, oh yeah, CRM's a massive market. You might be worried about competing with Salesforce and HubSpot, but it's a massive market. Versus, if I told you, hey, SaaS targeting like construction or something, you might not know how big that market is. And, that's a hard thing for us to evaluate. And we spend a lot of time trying to think through, what that means. Do we really have confidence building it up? We try to, think about the buyers, margins of those companies, really what the impact of the technology is going to be. And, try to build some thesis around whether we can imagine it's a big market. I think there are a lot of SaaS businesses today that are raising venture that is going to end, poorly for investors and founders, because I think a lot of these businesses that are getting funded just simply aren't large opportunities. And the problem with venture, or not problem, but it's a bug and a feature, right? That if you're building something that can go to the moon, you want a rocket, right? But if it's not going to the moon and that's not the mission, taking venture money can end up in just flames, because, you're trying to force growth. You're taking equity from the founders. I mean, it's just for lots of different reasons. I mean, venture is an awesome path if you have a high growth, big market. But if you don't have those things, there might be better paths. And it's been neat to see over the last decade, there's been venture models that people are trying to do to support that whole class of businesses too. I think it's a little bit unknown how that's going to work out, but it's been neat to see that, people are exploring different models and how they fund it and what the return profiles should be and so forth.
I wonder, as you mentioned, you guys go to market for SaaS companies. Can you use one of your portfolio company as an example to unpack that a little bit on like the playbook side?
Sorry, Grace, you broke up.
Sorry. Yeah. So we were just chatting about, you mentioned, there's you guys develop a playbook for the B2B SaaS company in terms of
Yes.
go to market. Can we use one of your portfolio company as an example on how you help them to develop the strategies to, put them on the right path in terms of go to market and everything?
Yeah, sure. Yeah. I mean, one of the companies that, I'm excited about today that I'm involved with is a company called Workato. Okay. And what Workato does is it automates workflows and is using now AI, to your question earlier about how AI can accelerate and improve how you automate workflows within B2B companies. And when we first invested in the business, I think it was in 2015, they had predominantly a product-led growth strategy. And I'm probably most of the audience knows what that means, but it basically means you have a product that users can, download, access, get value without ever talking to a salesperson. And then ultimately, you're usually selling them something once they kind of see that value. And that's really what the sales motion is all about. The challenge though at Workato was we found that there was a lot of those PLG users, but it wasn't really converting into enterprise sales. So we worked a lot of hours reworking the sales plan around that go-to-market to really identify what those the ideal customer profiles, what those use cases were that were working, and we completely retooled the go-to-market motion there to really to be more of a traditional kind of outbound, inbound marketing motion. Targeting, the mid-market and enterprise businesses. So yeah, that's it's a good example. It was still selling to B2B buyers, but it went from a PLG motion to more of what people would think of more of an enterprise motion. And we do that a lot where sometimes there'll be a company we're working with that has done an amazing job, let's say with their existing, let's say, direct motion that they're running. But in order to really augment that and support that, adding a PLG motion in addition to it, that can help create a lot of top of the funnel and awareness and really augment what they're already doing on the enterprise side. So yeah, it's a good example.
I wonder, so when you mention like you help them like find their ICP and then like essentially change them to, like, as you mentioned, like to like the mid-market, more of like a normal like outbound or inbound sales motion. I wonder, have you developed like like, I guess, like how do you since like a lot of like investors would go really deep into like help a company building out their like go-to-market strategy, have you developed some sort of like system that you feel like would work on, like, call it 80% of the SaaS company, or do you feel like this is like really case by case? And in terms of like because of like, since you invest in so many different sectors of like B2B SaaS companies, I wonder, do you see like overall trends that like these companies typically need help with XYZ, so you decided to like build that as like a particular skill?
Well, I think we absolutely, one of the reasons, again, we have that North Star being go to market is, I think most B2B companies, it is very hard to work that scale from, a dozen or so customers to really figuring out how to build that out over time. And that comes in a lot of different forms. It comes in, like, for example, one of the things that we're often focusing on and helping with is it goes from founder-led sales to a sales team. And that transition is incredibly hard to do. It is not, to state the obvious, it's not as simple as going out and hiring a VP of sales and bringing them in and then everything just kind of works, right? I mean, it has to, founders, for example, are very good at dealing with lots of different situations because they know the product, they know the market, they've spent so much time living it, and usually are very technical as well, that they can have these customer conversations that's just unreasonable to expect a salesperson to have, for example. I mean, I could talk about it for hours, but those are the kind of the transitions that are consistent across no matter what B2B SaaS category we're looking at. Generally, they all run into those same sorts of challenges. And, look, we are, I think as good as any venture firm in helping B2B SaaS companies navigate those challenges, because that's all we do. And that's all we've done for 24 years. But there's no magic bullet, right? There's no like perfect solution. There's no magic wand that can come in and, and each situation's a little bit different, with the personalities around the table, the industry, the margin. I mean, there's all sorts of things that come into play too that, can impact it. But that's generally how we approach it and think about it.
Can you chat a little bit more about like, call it like this week or in the past month, what is that company that like kind of caught you eye? And then like, how did you kind of quickly evaluate if this is like a company that you would put money in versus their competitors?
Yeah, so sure. I mean, we met a company. I'll just kind of give you it's an example. I'm not going to name the company, but I'll sort of speak in kind of generalities so you can kind of get the idea. I was introduced to a new business, had never met the founder through someone I've known for 15 years when she used to be here in Silicon Valley. And she said, "Hey, this is a founder I've been working with. They made a ton of traction. I'd really like you to, meet them and take a meeting." Was delighted to hear from her. I took a meeting, and I didn't know the market that they were in, which, is not totally unusual, but it doesn't happen often that I've never looked at a particular market that a founder is focused on, just because, we've been doing B2B SaaS for a long time. But there are still pockets, of the economy like GovTech, which this company was focused on, that, just haven't adopted as much software and have the need for efficiency, have a really hard time hiring new employees today for lots of other reasons. And so technology is having a big impact on how they do operations. I met with the founder. It was an amazing story. The founder had a very unique background to solve the problem, in terms of what they had done in their career and where they had spent time. I'm always a little nervous when I meet with a founder that's applying a technology into an industry, especially if it's kind of a vertical, if they really haven't spent time there and they really don't know the players, because you find sometimes in these verticals, there's sort of some gotchas and there's a language that they speak. And so just understanding how to build the product requires a little bit of understanding about that industry. It's not just about the tech. Anyway, this founder had that in spades. And so we dove in and spent a tremendous amount of time on it. We ultimately, just haven't yet been able to build conviction about ultimately how big the market is, I guess, just to the question you asked me, a bit ago. But in terms of, we probably meet, 1,000 qualified businesses every year, my team, something like that. I would guess, maybe more. We certainly get a lot more inbound, but let's say we actually take 1,000 meetings a year. We're only going to invest in 6 to 12 new companies a year. And we probably will do diligence on maybe another 30 or something. So, we spent a lot of time for us digging into the opportunity because it's really compelling. And I think if I had more familiarity with the market, it probably would have been easier to build conviction. But I think it's not just me. I think it's in general for venture investors. It's probably the hardest thing sometimes is when you just don't know how big the opportunity is. It can be hard to build conviction.
I wonder, so how do you pick which market to go deeper in? Since I feel like you have overall SaaS generalist fund. Nowadays, I feel like all the younger investors are more call it emerging managers. People are trying to go very niche in a very niche subcategory in general. What's your thought on what are things that you want to not spend time on in the SaaS space? And
you said not spend time on?
Yeah.
Okay.
So I feel like SaaS space is becoming for younger investors or the emerging managers or associates who are trying to build a niche on top of something. It's people are going into very niche space. But you have a generalist approach. I wonder, how do you pick what are things that you don't want to spend time on? And as you mentioned, there's things that you don't understand about a specific subject or specific how big the market is in a particular sector. I can totally relate to you. But I wonder, how do you do the general diligence on basically, I guess I will go back to the questions, what are things that you don't want to spend time on, and then why?
Well, I think it's going to all sound probably pretty obvious things. I mean, look, we're not interested in small markets. To execute in a relatively small market requires perfect precision execution, because you have to continue to build off of that. And the way I sort of describe it, sometimes you just don't have sea room in order to operate. If you're at sea, you want to stay off a lee shore because you can't always predict the weather and the tides. And so you want to have room to maneuver. And if you're operating, even if it's in a vertical that maybe has the potential to be big, but you just don't, there's not much margin for error in terms of getting it right. And I mean, most of the time, the initial spec and how founders think about what the customer wants is not exactly right. It's close, it's directionally correct, and that doesn't, sometimes they nail it, they get it exactly right. But, it's an iterative process. It takes time talking to customers, building it out. And we could talk about that whole piece of it too. But anyway, as a result, small markets are a problem. So let's start with that. The second thing, oh, sorry, go ahead.
Oh, sorry. I have a piggyback question on the small market because I feel like nowadays, like, although like something may start small, like since like Uber was like a black car and then now it become like a car for everyone. So how do you kind of define a small market?
Well, yeah, I mean, Uber never had a problem with a small market. Even as a black car service, I mean, think about the demand, the number of the number of taxis and black car. I mean, that's a massive market. That was never their issue, right? The issue for Uber was, could they recruit drivers, right? Could they build the tech stack and do it in an efficient, profitable way, which they did. They did an amazing job of getting that done. Now, I'm not sure they would have articulated it that way when they started, but it was never a question of market size. I mean, most consumer businesses like that, it's not a function of market size. I mean, Airbnb, I mean, all these things are massive. It's not the market. It's just, can they actually build a great business in that category? So, I mean, how we think about market size is really the number of, it's basic stuff. Like, how many buyers do we really think there are of the product? What are they willing to pay? Right? It's a big, I mean, it's going to sound really trivial, Grace, but like, if a buyer is willing to pay $100,000 versus $50,000 for a product, the market is twice as big. Okay. Mm-hmm. It's super simple, but you can quickly then see, oh, well, if they're only willing to pay $25,000 for the product, well, now all of a sudden we've just dramatically shrunk the market. And we have another problem now, which is, how are we going to go to market with it? Because if you're selling a $25,000 product, you really can't run a direct sales motion because the economics don't work, right? So now you've got to have more of a high velocity, low touch sales motion that's probably got a big PLG funnel on the front end, which can work for a lot of products, but it doesn't work for everything. So it's things like that it's kind of in conjunction with the market to think about whether or not we really believe the whole thing will work in terms of creating the business.
I really like what you said about like, think about basically like how, like, I guess like the market value and then how many people are in the buyer ecosystem. I wonder, so for example, if a company come to you and they are making a chip design software and like maybe they're selling to like a trading firm or like call it somewhere that like maybe you don't necessarily have like direct contacts with to the customer, how do you validate if the market actually exists? And sometimes I feel like it's also really hard because of like the quote unquote like I feel like the technology just generally changes really fast. How do you quickly evaluate if something have a longevity throughout the time that they're building the product?
Yeah, so there's two pieces to that. So markets we're not really familiar with, customers we're not familiar with, and then the technology, right? So look, we have to ultimately be able to get comfortable with the market and customer set. And I guess just being blunt, if we can't, we pass. I mean, it's just, because we don't have to invest in anything. Okay. Any particular deal. I mean, we have to generate returns for our investors, but any particular deal, we don't have to do it. So if we can't get comfortable with the market, we're going to pass. And it really it's not necessarily a indictment of the business. It's just, we didn't understand the market enough to get conviction to invest, right? In one of those, 6 to 10 deals we might do a year, right? It just couldn't get there. There are some interesting services now that are out there, these expert networks. They used to be terrible, 10 years ago. They really were. They were just terrible, but they've gotten a lot better. They've actually gotten a lot better now, these expert networks. And so, I think thanks to private equity mainly, who are the big buyers of them. But we use some of the expert networks now, and that can expand our access to those customers. We have a pretty big network just at Storm, having done this for 24 years. So we can get to a lot of people to at least sanity check markets, at least initially, to sort of get a quick read on things. So it's kind of, it's all the above. But ultimately, to answer your question, if we can't get comfortable with the customer set, then we'll pass just because, we couldn't answer it affirmatively.
How do you feel like they, for example, if a company presented to you that like they do have a initial customer, but the initial customer is like they're 100% of customers at the moment. Like, for example, they're saying they're selling a very high ticket item to like call it like selective amount of companies. The market is big in terms of like the money is there, but however, like they only have call it like very few amount of customer they could go after.
Yep.
Because they're
Yes.
selling something that's so high
Yep.
price.
Yep. Yeah. No, it's a great question. You know, when I started my career, the big companies people were selling to was the telcos. Okay. The AT&Ts, right? The Nortels, which went bankrupt, but like all the CLECs, right? All these big telco companies, but there weren't that many of them, right? And it was very hard to sell to these companies. I mean, the same today might be said if you're trying to sell to Amazon or GCP or Azure. I mean, that's brutal. It's tough because you're just not that many customers that you can sell to, even though their aggregate spend is massive, right? Like or another example sometimes people use is like anyone that's had an experience trying to sell to Walmart, like it's amazing in a way because it's such a well-run company, but Walmart like negotiates very hard on things because of their scale. And even though the dollar amounts might be large, it's a tricky company to sort of work with as a result. So, in general, if there's a very limited set of customers that you can sell to, even if it's a high ticket item, I'd say, from a market standpoint, that's a concern for us, right? Unless we really understand why are those customers buying? And it begs other questions you really got to get into. What's interesting now is there are a lot of venture investors. We're not one of them, but there's a lot of venture investors that are spending a lot of time in defense tech. Mm-hmm. Well, that's got one customer, basically. Government. So, and maybe there's multiple buyers within the DoD, and I'm sure they would tell me I'm stupid and I don't know what I'm talking about, with respect to their customer set. But even within the DoD in the US, like if you consider that's one customer, even though it's maybe multiple buyers, that's the pinnacle of that, right? Huge dollars, very concentrated customer set. And what's great about venture today is there's a bunch of funds that are very successful that believe that's totally possible. And that's great. And they're building, great businesses. And that's awesome because we don't have to compete with those guys.
How do you kind of quickly study how a market, how a market, how does the money flow in the market? So I saw that you have invested in like marketing software category. And I wonder so I feel like that's a category that I like rarely hear about people talking about. Can you share a little bit more about like how does the money flow in that category?
How you mean in terms of just marketing software in general? Like how does the money flow in terms of what? In terms of new investments or the buyer journey or?
Yeah, the buyer journey. Like for example, like who is buying like these softwares typically, and then how do you see, for example, a company that you have invested kind of like play in that ecosystem that you think they will make a big impact?
Yeah. So I think the general trend in SaaS for marketing over the last, call it decade has been where we started at fairly large organizations that could afford to implement fairly complex systems to gain advantages. And then over time, software companies have done a great job of simplification, ease of use, and lowering the barriers to adoption. One of the successful companies we invested in years ago was Marketo, a marketing automation company, one of the earliest ones, did very well, ultimately went public. I remember getting a seat myself for Marketo because we were investors there. And I was like, oh, I'm going to use Marketo. I'm going to set it up and, make it work. I mean, it took me days to figure out how to use Marketo. Now, I wasn't their target user. But most people aren't willing to spend days learning new applications. So what Marketo, and it was challenging at the time because I think people didn't know the vocabulary. They didn't know how best, but what Marketo did was it really opened up the door And now, whether it's HubSpot or others, it's just so much simpler now to use. And so it's much more accessible for everybody. And that trend in SaaS has been, I think, really powerful in lots of categories, but particularly in marketing, sales and marketing. Because if you think about it, everybody needs a CRM, right? I mean, everybody does. There's maybe even an argument you want a personal CRM, but every business really ought to have a CRM of some kind. But most people don't want to invest the time and energy and cost for like a Salesforce. So, okay, well, what am I going to do instead, right? We invest in a company called Pipedrive. It was a good example. It was more an SMB focused that did really, really well, super easy to use. You can, download it. You don't need to talk to any salespeople, get it up and running, and it does exactly what you need it to do for your business. So in marketing today, to answer your question, we're looking for businesses that kind of continue on that trend, like ease of use, right? And then I think the biggest question that's maybe a little more unique to sales and marketing is, really, do you provide something that's different than what's out there today? Because there are so many companies that have gotten started in that sales and marketing tool space. It's very noisy. And one of the problems when there's so much noise is it means you have to spend a lot more money in marketing generally to get customers, certainly at scale. And so you really have to have something that is unique or a unique take on the market. Otherwise, scaling the business becomes fairly expensive over time, even if you have like a great product, just simply because of the dynamics in the market. So if you look at sales and marketing software, despite our successes over the years, we've done incredibly well in that category. The number of like net new sales and marketing companies that we're doing, it's lower than other categories. But you asked me about AI at the beginning. We just funded a company that's in stealth, that's basically applying AI to the whole marketing workflow. It's a founder I've known for 15 years. She's fantastic. And she's got a lot of, interested CMOs that have given her good feedback, and we'll see. And so her approach, because she's rebuilding the stack from the ground up using AI, that was different for us in terms of, being able to, find, a path forward relative to maybe, something else. It reminds me, you asked me a question earlier about what we, maybe we don't want to do. And the expense of building in these competitive markets reminded me, one of the things that's just not a fit for Storm is capital intensive companies, right? Companies that are going to need to raise a lot of money. I mentioned the AI infrastructure earlier. That's a good example of, it's not a good fit for us because it's raising a lot of money. And I'm not making a judgment about whether or not it's a good business or not. It's not that. It's just, it's not a good fit for Storm. And so anything that requires a tremendous amount of capital, it's a better fit for $1 billion fund. I mean, someone who wants to deploy a tremendous amount of capital, like an Andreessen, it's a great fit for them. It's not as good a fit, for us.
Do you have a benchmark that like you're using to judge if something will require like a lot of capital? So obviously, like if you're building like a foundational model, like that will require a lot of like money. But like what if like something is non-obvious, and then like, or like what would be your benchmark on like something that, like what kind of like how much like you would put in that to see what kind of result, like maybe like a matrix or something?
You mean like how much money would we be willing to put in to see what the next?
The next milestone the company have to achieve.
Yeah. So, I don't have like a quantitative answer to that. Our initial checks range from $1 million to $6 million. It's a pretty big range. Companies that have a little bit more traction, we're more inclined to put in a little bit more money. So the bigger checks go into those businesses versus the ones that are slightly earlier will generally take smaller checks. Mm-hmm. But I think we want to fund a business. Maybe the way to answer your question is we want to fund a business to really get to that next kind of value creation point to really be able to demonstrate that the business has really progressed. So for example, if a company, let's say, has, a dozen customers today, and, maybe they're at just shy of $1 million of ARR. Well, if they get to 24 customers and have, just shy of 2 million of ARR, I'm not sure that's really a huge milestone for the business. It's great in terms of execution, and, it's not easy to do. It's hard, but in terms of like an investor mindset, and kind of if you're thinking about what it takes to kind of go raise that next round, probably they're going to need to get a little bit further. So we're going to want to think about, do they have enough runway to get maybe to, $3 or $4 million in ARR, and where they're going to have more of a sales team. They're going to be able to show the repeatable go-to-market motion, which then for a whole nother set of investors that are sort of looking for that and really want to fund growth capital, it's a great fit. So I think, that factors into our thinking, I think, a little bit, in terms of what's going in. Obviously a factor too is how much money the founder wants to raise, in terms of their dilution and, how they're thinking about it, and valuation and all that sort of factors into. So it's a mix of a whole bunch of different things, but, outside of just maybe stating the obvious that we're putting in more money in companies that are slightly later and less that are slightly earlier, it's a whole combination of different things.
I wonder, what's your thought process on like portfolio construction? Obviously, since like you're making, call it like 6 to 10 companies, investing 6 to 10 companies per year. I feel like it sounds like it's a fairly concentrated model, and I wonder, like, how do you think about like portfolio construction in general?
Yeah. So we've actually been really consistent on this over the years. I think it's served us really well, and our LPs in terms of like the return profile of the fund. We're typically investing in 30 to 40 names in a given fund. Okay. So, we'll have 30 to 40 companies in each fund. And, in terms of venture, if you're looking at a seed fund, it's not very diversified. If you're looking at a growth fund, later stage, it's pretty diversified. A lot of buyout funds will only invest in a half dozen names or something, right? So it all kind of depends on the perspective. But that's sort of what we're looking for in terms of portfolio construction. And, over the life of a business, we'll try to invest, up to maybe 15 million per company that is doing well, and try to be very disciplined with those that maybe the business isn't working or it's more challenged, and to, try to find either to sell the business or, merge it or something, if it doesn't make as much sense. But for the ones that are doing well over the lifetime, put in maybe 15 million per company. And like with most venture investors, there's a lot of people that have talked about it. It's been true for us for years. We always have 3, 4, 5 companies in a portfolio that drive 80+% of the returns. So it is quite remarkable. That is always the case. And I wish I could, when we invest, know which 4 to 5 it's going to be. But it's pretty unpredictable. So what we try to do is to have a repeatable strategy where we're looking for very similar sorts of profiles of businesses, where we can kind of create that portfolio of opportunities where we'll generate that 4 to 5 out the other side. So, we try to be fairly consistent in that, so that we generate that set of opportunities. I think what gets a lot of venture investors into trouble is they're chasing trends and chasing strategies, and then when they look back over the portfolio, it's like it's all over the place, and they might get lucky in terms of what they invested in, but it's certainly not repeatable.
How do you think about, like, so nowadays I feel like for people who are like the younger fund managers, a lot of people were their performance are judged by if the follow on run will come in by like big name investors or something, I wonder what's your thought process on like building the like follow on round investor network, and how do you kind of like um evaluate your deal flow, or like evaluate the deal based off like, what this company be pick up by like other funds later on? Like, do you chat with other investors like early on before you input money in, or do you feel like
About whether they're going to be interested later?
yeah.
No. Yeah, no, I can't think we've ever asked, so, oh, hey, is this something you'd want to invest in later? Look, I think most investors, there's definitely some investors who chase FOMO and want to be in all the cool companies. And like, there are some that are like that. But I think most investors, they're looking for great businesses. I mean, they want to find great businesses in great markets with great teams. And so our job at the stage that we invest is to help those companies really achieve that. Like, that's what we have to sort of create. And if we do our job right, and really help those founders, move the ball forward on all those fronts, then good things happen. And if we don't, then then it doesn't work out so well. But no, it's hard. I think to make my point, I think a lot of founders sometimes they find it frustrating. They'll meet with venture investors and they'll say, everybody says it's too early. Everybody says if I had another $1 million of revenue or I had another 10 customers, then they'd want to invest. And the truth is that's always the case. That's never ending, right? I mean, even into a public company. I mean, that's, because, investors always want to see more. They always want to take less risk. They always want to see more growth. And so asking investors about, hey, is this something you'd invest in? I don't think we'd get like a great, we wouldn't get any great answers on it. I mean, I think I'll give you another example too. I think to be great as an investor, you must be comfortable having people think what you're investing in doesn't make sense. Mm-hmm. You just have to, because you have to be somewhat contrarian as a venture investor. Because if you're just investing what everybody thinks is like an awesome investment, one of two things is going on. Either the wool's getting pulled over your eyes, or two, you're paying a very high price to get in. And maybe that works, but paying a high price doesn't, that's not going to generate great returns either, right? So, I mean, any way you sort of cut it, I think you basically have to be comfortable building conviction yourself as a team. And we work at Storm, we're very much a team. We're not kind of lone wolves, but as a team, we have to build conviction around the things we're investing in, and be comfortable with that. And know sometimes we get it right, and then sometimes we don't. And we try to learn from where we got it wrong. But really, having that conviction yourselves it's incredibly important. I mean, at the stage we invest in, like I read a lot, I listen to a lot of podcasts, but the reality is I'm not going to get necessarily insight from what the media is reporting. By the time companies in our sector have done reasonably well and the media is reporting on them, it's outside of our investment window. So, we just really have to have conviction ourselves.
Totally. I wonder, what does it look like when you were first time raising Storm Ventures back in 23 years ago?
It was very different. It was very different. First of all, it was a bunch of white guys. Let's just start. We'll just put that right on the table. Okay. There was maybe one or two female investors, but it was a very, just a kind of like an old boys club. Like, it was very clubby. Everybody was, for the most part, based here in Silicon Valley. There were some that were in the city, but most were here. the number of firms that existed back then, I mean, you're going to find this amazing. I mean, I knew every firm. I knew every single firm, and I probably knew most of their portfolio, and I had probably met half or more of their partners. That's how small it was. Mm-hmm. You know, and you know, since you talk to folks constantly, you just know, I mean, there's so many firms and partners. I mean, you can't possibly keep up with it anymore. I mean, it's amazing, right? So that's really changed. I think, you know, I mean, there were some good things about the venture business then in terms of, you know, competition and so forth. But I think on balance, the industry is 1,000x better today, right? Because I think whenever it's small like that, capital was really constrained to a few firms. The whole concept of emerging managers, I mean, it existed, but it was just so hard to raise a fund then, largely because most LPs weren't interested in venture. And we can talk about that forever. But anyway, it was so much harder than compared to today that I think it's just much, much better. Founders have a lot more choices today, you know, in terms of what they invest in, or I mean, in terms of who they can raise money from, that are just super high quality firms. All that is just, you know, it's much better for the industry.
I wonder, so when, like, since like you are in the industry for like over 23 years, or like not in the industry, but like more of like you built your own firms for over 23 years. Whenever there's like a big wave of like a bunch of new people coming into the ecosystem, like do you encounter the challenge of like chatting with LPs because they have more options? Or do you feel like, since like the other day I saw there's like a report out there that's about like 45% of venture dollars still goes to like the 5 big funds or maybe 10 big funds, something like that. And I wonder, do you feel like there's like a more competition, or do you feel like you're stable with your existing LP throughout the time? And like, what's your thought process, or like, what's your advice for like the younger fund managers who came into the ecosystem?
So I'm not sure I would use the word stable, but yeah, I mean, I think in general, the fundraising environment today, despite the headline sort of numbers compared to where it was when I started, it's much better today. I mean, people believe in venture. People like LPs want to invest in venture. That wasn't the case necessarily outside of some of the foundations and endowments back then. But today, I mean, a lot of people want to have access to venture, and that's, you know, really generated, you know, a lot of capital for the industry, which I think has been great. The big reason that these really big funds have done so well is that for the really large asset managers that manage trillions of dollars, whether it's sovereign wealth funds or massive pensions, look, they can't deal with a fund like mine or an emerging managers that's like, you know, 200-300 million. Like, it's just, they don't want to write a $25 million check. It's just too much work. They have too much money to invest. And the problem of going through like an intermediary is then you incur fees and expenses if you do that. So understandably, a lot of them want to look to these larger platforms that can give them access to venture, like Andreessen. And, you know, and I don't know what Andreessen's returns look like. They must be pretty good, I guess, because they continue to be able to raise, you know, very large funds. But they really, you know, I think it's a great fund for really large, like sovereign wealth groups, because, you know, they can write a $200-400 million check into Andreessen and get a lot of diversification and just, you know, and be done with their sort of their exposure to the asset class. So that's worked out well. It's kind of different things are happening that I think people tend to conflate in terms of what's going on in the fundraising environment. You know, in terms of emerging managers or new fund managers, I mean, look, the most important thing is to really focus on investing in great companies that generate returns. And it sounds, again, maybe a little obvious or old school, But there's a lot of people that got into venture maybe pre-COVID, and during the ZERP days invested a lot of money, invested in a bunch of companies like it was a job, but really have no track record to show for it. I mean, if you've been in venture for 10 years, as a principal, as an associate, let alone a partner, I mean, that's what you got to do. I mean, you got to be thinking every investment I make, I got to really think that this is going to drive a meaningful return. I think that's probably why I imagine there's a lot of new investors that are struggling with that today. And it's going to be very hard to go raise a new fund without a track record, to say the least, right? So that's what I would really focus on. But I do think, LPs are looking for new managers all the time. They're looking for new networks, right? Of where those networks are going to produce the next set of winners. And often those fund managers that come out of, really exciting companies, are going to get access to those new founders, and that's something they're looking for. So it's very much still alive and well, and it's happening. And again, it's probably, if you look at it over the span of time, it's an awesome time to be an emerging manager. But I certainly am sympathetic and understand it's very hard right now to be raising money, given the party that just ended a couple of years ago.
Totally. I feel you. And I wonder, when it comes to like building your own fund, how do you pick, like, since you have like other partners and other managing directors at the fund, how are you thinking about like finding people with like maybe complementary skill set, and like how do you kind of like build up your team throughout the years?
Yeah. It's, the team for us, we take, I don't know, we've done really, I guess, two things is what we've done. So two main things to talk about. So the first is, we realized years ago that it was pretty important to have some visibility into what's happening in like Europe and Asia. Because I just don't think today, if you're starting a SaaS company today, you just don't have to do it in Menlo Park, right? Or San Francisco. Okay. You can really start a company anywhere now. So we've made a lot of investment in Europe, and we've had a bunch of successes in Europe. So, in terms of how we think about the team now going forward, we're thinking about adding international team members that sort of complement what we're doing here in Silicon Valley and in the US in general. We've also got someone that's based in Korea. So that's, I think, part of how we think about adding to the team. In terms of the profiles of people, well, let me mention something else we do that's, I think, good for the team. So we're a small team today. We're 12 people, but we for years have had an EIR program where we constantly have really high caliber execs kind of embedded with us in our partner meetings, in meeting companies that give us feedback, tell us that we need to do better here, or this is great. And we've done that now for almost like 10 years, and we're constantly having new executives on the team. And I think it has really made us so much better as an investment group than if we didn't have that program in place. We probably don't have time to get into all of it, but the way to sort of think of it is that's like an extension of our team, because it's not just advisors. There's people that are sitting with us on a day-to-day basis. And then the final thing, when we think about adding to the team, I think there's generally two ways to run a venture fund. You can run it as kind of individuals with a book of business, kind of the way you'd run a law firm or an accounting firm. And it's super successful. And I think it's, especially as you get to some scale, it's really the only way to do it. It's hard to have a completely team-based approach. For us, because we're small, we're very team-based approach. So whether, Arun, or like, it's a very flat structure. And we look at all the deals together. We try to help each other on everything we're looking at, help on due diligence across the board. So we're looking for, the reason I mention that is it's very important to us when we add people to the team, they're thinking like that. They think about it. As a team, they want to be a part of a team. because there's a lot of people in venture that simply don't want to be really part of a team. They really want to focus on their thing, what they do well, and they want to invest in their companies, because really it can be a lone sport. I mean, look at all the solo GPs, right? It can be a solo sport if you want it to be in terms of the investing piece. That person would not work out well at Storm. So we really want that, the team perspective, and that's what we're looking for.
Totally. Hi, Mike. I want to say hi to the audience. Thank you so much for joining us. I want to be mindful of the time, although I have so many questions for you, but I want to keep it short for like the last 1 minute fire run. Okay. So first of all, what's your favorite book?
What was my favorite book?
Yeah.
The most recent one, I don't know if I have a favorite, but I just read The Green Mile, which is, it's a fantastic story about the Colorado River. And I recommend it to anybody that's got an interest in the history of energy in the country and conservation. And yeah, it's a great story.
Who would you invite to your dinner party?
What's my dinner party? Like currently living?
Yeah. Or like it's your party. So
I mean, I don't know. I'd really like to meet Barack and Michelle Obama. I think that'd be pretty awesome.
Who made the biggest impact in your career?
I'd say really two people. One, the first was when I was in college, I took some classes at a business school, and there was a lecturer there at the time. Now he's a very famous author. His name is Jim Collins. And he let me basically audit some of his classes and really taught me about business and gave me a perspective as an undergraduate that I just wouldn't have had, and really was, had a big impact on my career. Along with, I should mention too, a guy named Steve Wesley, who most people know here in California, who was also a lecturer at the time at the business school, and spent a lot of time with me as well. And it's in fact, because I think as a young person, I didn't know what business was. I didn't know, my dad wasn't an investment banker. I didn't know any of this stuff. I didn't know tech. So that was all impactful. But the person I think, that really was critical for me after those two in school was my partner, Sanjay. So I worked, after I was at Summit Partners, I went and I joined a fiber optics business. And my partner Sanjay at the time was CFO and COO of eTech. We ultimately took that company public. It did incredibly well, and we sold it, 3 years later to another public company. But he gave me a lot of responsibility for sort of what my experience set was, and it was a fantastic experience. And then we started Storm together, and I don't think I would have started a venture firm had it not been for the people. I mean, the people have had such a huge impact on me. All my partners, Tae, Arun, and Alex. But, Sanjay, I wouldn't be at Storm if it wasn't for Sanjay and us starting it together.
Amazing. So you have a YouTube series called As a VC. If people want to watch one, like, what's your favorite video that like people should watch?
I don't know if, it's a great question. I don't have a favorite video per se, but just so everyone knows, I mean, my Ask a VC, it's very prescriptive around B2B SaaS founders and how do you really grow the business. I don't even know which one's the most popular. I should probably know that about my own set of videos.
Oh, I can tell you which one is the most popular.
Okay, which one is
SaaS churn? What is it?
Okay, all right. Well, then that's my favorite. That's my favorite.
Okay, amazing. Where can we find you outside of work?
You mean outside of? You mean on social media stuff or what?
Or like just your hobby as well.
Definitely my guilty pleasure. Well, you can see there's a guitar in the background. I'm sort of an super amateur musician. I definitely enjoy that. And the other thing, my other guilty pleasure is I surf a lot. So you can find me on the beaches in San Mateo County a couple mornings a week.
Amazing. Well, Ryan, thank you so much for coming on the show today.
All right. Thanks, Grace. All right.